Wealth management is not just for the wealthy. Everyone is entitled to their best retirement possible. Welcome to The Retirement Engineer with Jim Kruzan, your path to a bigger, bolder retirement. Brought to you by Kaydan Wealth Management, a firm that specializes in serving the mobility technology industry. In this podcast, we help you maximize your resources and engineer your best retirement through a process-driven approach so you can get the little things right. Drawing from years of expertise, Jim and his guests will simplify complex wealth management strategies and explore actionable ideas to help you protect your hard-earned wealth and take control of your future. Now, on to the show.
Welcome back to The Retirement Engineer. I'm Patrice Sikora, joined by your host, Jim Kruzan. Today, we have a special guest with us, Dylan Stewart. He's from the Kaydan Wealth Management team. Dylan is an essential part of the Kaydan Wealth Advisory team as a certified financial planner and certified public accountant. Dylan is going to help us unravel the complexities of required minimum distributions, or RMDs. Now, whether you're nearing retirement age or planning well in advance, understanding RMDs is crucial to avoid unnecessary taxes or penalties and optimize your retirement savings. So let's get started and navigate these waters together. Jim?
Well, thanks, Patrice. And we're so happy to welcome Dylan as someone with extensive tax experience, as well as a highly regarded member of the team. I thought there's nobody better here at Kaydan to kind of talk a bit about the intricacies of retirement planning as it relates to minimum required distributions. It is the backbone to a lot of the cash flow that our clients deal with in retirement. So I thought I would throw it to Dylan first to kind of talk a little bit about unpacking these basics of required minimum distributions and their significance as it relates to cash flow planning and retirement. So Dylan, take it away.
Thank you so much, Jim. I appreciate being a part of this podcast as well as part of your advisory firm. I definitely feel like I found home here working with you and alongside your team. So essentially, with required minimum distributions, the government more or less for a lot of your pre-tax or retirement accounts essentially has said, over the years, you've accumulated all these assets within these accounts. And at a certain point, we need to turn on the spigot of sorts where you have to take these distributions, at least a minimum distribution, in order to ensure that the federal, and depending on your state, the state gets some tax revenues. So in terms of required minimum distributions, it's very important that we understand kind of when that spigot is being turned on so that we can do a lot of planning kind of before it's turned on as well as while it's turned on, because we've had a lot of success stories with clients over the years whereby taking a look and seeing where their future income projects to be while Social Security and required minimum distributions are turned on, and by kind of planning for the future to see where they're at, it makes decisions today much easier to make. For example, we often have clients that'll be in kind of higher marginal tax brackets. And by seeing that, noticing that as a future outcome that is likely to proliferate, by taking advantage of even before required minimum distributions are turned on, we can normally get some money via Roth conversions over into an after-tax bucket and compounding so that later on when required minimum distributions start, they aren't having to take as much. They're not at as high of a marginal tax bracket, and it certainly helps with winning the tax game, if you will. So in terms of some other situations, we've had some good ones, and then we've heard of some not so great ones out there whereby clients have an old 401k and they're rolling it into an IRA. They're supposed to be taking their RMD, but there's a bit of a shuffling of accounts. So usually any of the calculations for RMDs kind of start off the previous year's ending balance. But when you're adding additional monies into retirement accounts, you got to also consider those new monies coming in. So there's ways to get around any penalties of misrequired distributions. You generally want to do it within 2 years, but certainly the idea is to make sure they all get distributed on time and kind of have your tax planning situation in order.
Just to add to some of these other mistakes, the idea is we want the best possible outcome with all of our clients. And sometimes as we're talking to new clients, those that are new to the firm and kind of looking what they've done over the past, especially if they're kind of beyond that required minimum distribution age, we sometimes see issues and errors. And as you said, there's a kind of a window of opportunity to kind of go back and fix those. But not every situation is perfect. There are issues that we notice, things that happen that probably could have been avoided. Beyond just simply forgetting about taking a required minimum distribution, can you think of other kind of problems, mistakes from the trenches, so to speak?
Yeah, there's a few that definitely come to mind. One of which is, firstly, when they start. And a lot of clients, they've heard over the years that it starts at 70 and a half. That was since moved up to 72. And then even more recently moved to kind of 73 if you're born between 1951 and 1959. And then kind of 1960 or later, it's essentially 75. So one of the big things that we've seen is a lot of clients kind of being in this situation, what's called a Social Security tax torpedo, whereby if we're taking required minimum distributions now, not only is that going to be taxable, but there's potentially a chance whereby they'll also now have very little or previously had very little Social Security being taxed, but now that's being taxed as well. So it almost feels like this required minimum distribution is being double taxed. So there's some ways around that. The first year, when you take your required minimum distribution, you're normally able to delay it essentially into the first quarter of the following year. So kind of doubling up in the second year of required minimum distributions is something that we've seen that has created pretty good outcomes for clients. And then another one is where our firm is able to help a ton with tax pro formas to kind of see where your income will be, but those nasty IRMA, income related monthly adjustment amounts. Basically, you'll have to pay more for the same Medicare as everybody else if you kind of trip these wires. If you're $1 over certain income thresholds, it'll make it so that you owe a whole lot more for Medicare. So by doing a bit of tax planning, understanding what your required minimum distributions are, where your other income sources are coming from, we're better able to ensure that, we're either taking those required minimum distributions thoughtfully, or we're doing other things that allow the required minimum distribution amount to go down to keep your income down. So we're not bumping you up into higher IRMA brackets as it relates to Medicare.
Let's continue on the subject of things that might go wrong. We talked about not taking into consideration things like IRMA, things like the Social Security torpedo. All these things are things that require planning. It requires cash flow management. It requires literally projecting out kind of what the situation will look like down the road, make some projections on taxes, and then make some adjustments. It's truly eye-opening when we can show clients where we have the ability to potentially reduce tax liability in the aggregate and certainly down the road, avoiding some of these stumbling blocks by planning ahead and taking decisive action now, which might be many, many years away from the RMD. But there are other things that trip people up as well. And I just want to focus on two quick examples, almost as if they're the opposite side of the coin. The first problem that we see sometimes with people who are currently at the age of required minimum distribution is they don't understand, or they've heard that, well, as long as I'm working, I don't need to take my required minimum distribution. That's partially true. If you're currently working and you're over the age of required minimum distribution, let's use this year as an example, and that would be 73, and you're working for an employer full-time, and he's providing a 401k to which you are participating, you can delay the required minimum distribution off of that. That said, you cannot delay the required minimum distribution on any of the IRAs that you have, nor can you delay the minimum required distribution on any dormant 401ks you might have out there as well. So it's also important as we're planning and we're moving closer to the required minimum distribution age, we may want to look at doing some consolidation. We may want to look at moving some of these assets to provide better flexibility. As an example, if I have a client who has a few de minimis IRAs, bulk of their retirement is in a 401k with the same employer he's had throughout, still working, still participating, with no desire to retire anytime soon. So this is somebody who's still fully engaged at 73. It may very well make sense, depending on how those IRAs were structured, whether they were rollouts or rollovers from other 401ks, we might want to roll those back in to the employer's 401k. That way, he has no IRAs, he's still working, and he can then delay taking required minimum distribution. So there's a lot of fuzziness in what you can and can't do there. The other issue has to do with aggregation. And what that's all about is if you are taking required minimum distribution and you have a whole bunch of individual IRAs out there, you don't have to take the required minimum distribution from each and every IRA. You can simply total up the ending balance as of last year, figure out what the required minimum distribution is, and you can assign that to any one of or many of those IRAs. You could take it out of one IRA as opposed to half a dozen. The trip up is you can't do that with 401ks. So if you have multiple 401ks that are sitting out there, even though you can aggregate the totals in the IRA, you can't do that with 401k, and each and every 401k will need to process their own RMD. This is a huge trip up. We find this to be a mistake. And often when we're aware of it, it's a new client who's made that same mistake year in and year out. So it's something to consider as well. Dylan, did you want to add something to that?
No, actually, exactly. Your second point was exactly what I was going to say about how the 401ks, there definitely isn't as much flexibility, but with the IRAs, there is. But to your point, potentially, if they're still working, getting everything back to a 401k or a 403b can minimize the amount of required minimum distributions while their income is still so high from their employment. But similarly, with the IRAs, the fact that there may be multiple out there, but we only need to take from one account, the IRAs are a bit more flexible in that sense. So yeah, it's definitely very dependent on the client situation, what is best for their family, themselves, their financial future. So yeah, thank you so much for sharing that, Jim.
Absolutely. So now that we've talked about some of the things that can truly go wrong and certainly impact not only retirement plan cash flow, but tax liability, let's spend a little bit more time. And I know, Dylan, you've touched on this already, how proper planning ahead can really make a huge difference, both in terms of tax liability, avoiding these IRMA limits, the Social Security bullet, etc. Before I ask you for a couple more examples of that, just to be clear, the Social Security torpedo, what is this thing that we're talking about? Social Security is a really weird animal in that the way it's taxed and how we calculate the tax on that is unlike anything else. It's not as simple as what earnings I have or what amount of money I've received. It doesn't even have to do with your tax bracket. It's kind of a made up number. And depending on where you are with respect to that number, you either pay nothing for Social Security or you include half of the proceeds as taxable income, or you include 85% of what you receive as taxable income. And this torpedo thing that we're talking about is if you're oblivious to this, depending on the amount of income you're taking in any one given year, not only are we dealing with a higher tax bracket potentially, because now you have more income and you're paying more in taxes, but now you're also including an even greater amount of Social Security, which can dramatically tip this thing in favor of the IRS. So we want to avoid that altogether. So Dylan, let me just ask for a couple other examples of cash flow planning gone right.
Yeah, to your point, Jim, generally it's not the best time to start considering how to best manage required minimum distributions when you're about to start them. It's usually upon retirement, getting a plan in place, understanding where future income projects to be and where you're at today, in addition to your lifestyle and spending needs, to determine kind of a plan from there to really execute over, let's say, for example, a client retiring at maybe 60. We know somewhere Social Security is going to get turned on 62 if they're not in the best of health or there's a major market downturn and we're trying to take some stress off the portfolio. 67 for a lot of folks, full retirement age, the amount at which they're able to, if they have a spouse, kind of protect the amount that's going to them if they were to predecease a spouse. And then ultimately 70 if you're still in pretty good health, the account's holding up well, all that type of stuff. So we know Social Security is going to get turned on. And then some point thereafter with required minimum distributions at 73 or 75, well, you've got a lot of these very fixed income items that are going to be coming down the pipeline. So by us going in, determining how much you need to spend, figuring out where to best spend those monies from, determining where a future expected kind of tax rate is, and then comparing that to today, we can get some better solutions as to, should you be spending from your IRA or from your brokerage account? Should you be doing Roth conversions? Will you be at a much higher tax rate down the road? And the one big thing with that is sadly, as advisors, and it would make my job a whole lot easier, Jim, if I had a crystal ball, if I knew where tax rates were going to be tomorrow. So in many ways, you can kind of compare to the current tax tables to previous tax tables and kind of get a good idea. But for a lot of folks, the fact that Social Security is getting turned on, required minimum distributions are getting turned on, chances are they're going to be at a much higher tax rate, marginal tax rate in the future. So definitely trying to possibly spread out some of those incomes, spread out some of those monies, those taxable dollars over the course of their kind of 60s, well before required minimum distributions start. Because at that point, there is still some planning that can be done with qualified charitable distributions. When do we take your first required minimum distribution? But for the most part, the best planning will be done before they start, not when they start.
Very good. Thank you. Let's get into maybe the weeds a little bit. We talked a moment ago about delaying or not delaying minimum required distribution. I suppose there are some advantages to delaying, especially if that first year there might be a huge increase in taxable income and you're doing everything you can to delay or reduce that taxable income. Maybe you sold a business, maybe there was a huge capital gain, maybe you retired the year before and you got this huge payout in a non-qualified deferred comp or executive compensation situation where you're looking at finding ways of just tossing income to another year. What we have to also remember, though, for most of us, if we don't take it that first year and we accept the delay, which is, we can pay the first RMD by April 1st the following year, well, guess what? You've got to take 2 of those distributions that year. And for most folk, those who are kind of middle class, having 2 large distributions from the IRA in a single year might do all those nasty things that we're trying to avoid. Yeah. Torpedo Social Security and at the same time kind of blow through some of the IRMA limits where now, unbeknownst to you, you're going to be paying more for the Medicare that you enjoy. Beyond that, let me take just a moment and talk a little bit about the kind of the nitty gritty. So, okay, we're at that age, we're going to take a distribution. What does that mean? Well, for most of us, we deal with the IRS. There's a distribution table. There are really 2 tables that we work with. There's a joint and survivor table, and then there's a unified table. For most IRA RMD distributions, it's going to be the unified table. On rare occasion, if a spouse were to inherit an IRA from their spouse and there was a huge age gap, there may or may not be a reason for the spouse to then start taking distribution, and they probably more than likely would use this joint table. We're not going to get into the weeds on that. That's a very special situation. For most, we're on the unified table. And unfortunately, the way this works is the older you get year by year, the factor decreases, which means that the amount as a percentage you have to pull out increases. But just understand the first distribution you take from a percentage basis is the smallest distribution you're typically going to take, and it really starts to ramp up. Let me just give everybody an example of what that looks like. And then maybe we could talk a little bit about what can be done with these RMDs from the standpoint of, okay, we got to take them. Does that mean we necessarily have to spend them? So just to give everybody an idea, that first year, when you're 73, the factor is 26.5. So 1 divided by 26.5 is about 3.77%. That's the percent you got to take out of your account. If you've got $1 million, you're going to have to take $37,700. You can see why pushing 2 distributions in a single year might be a big tax issue. But just to give you an idea how quickly this ramps up, by the time we're age 80, that factor drops to 20.2, which is 4.95%, just a hair under 5%. I was just talking to a client yesterday. He's in great shape. He's been a client for 35 years. He's turning 87, and his factor is 14.4, which means he's going to have to take just a hair under 7% out of the account. So you can see the problem this creates, right? The older we are, the more we have to take out. So at some point, if the account is being managed somewhat conservatively, because we don't have a whole lot of time to dig out of big drops, we're now taking out as a percentage probably more than the portfolio has the ability to grow to. So this portfolio starts to diminish. So the issue then becomes, well, what do we do with this stuff? And there's some really cool things that can be done if we're not spending it for legacy, for charity, for all kinds of things. So Dylan, let me just throw it back to you for a quick second. And let's talk about what some of those other things that can be done, things that we've had our clients do with some of this money beyond just, well, I've got to take it out, I might as well spend it.
Yeah, thank you, Jim. And that's a question I get all the time from wonderful clients. And essentially, there's a few main options that I often see clients kind of take with that. First one, definitely the most common one, is taking that money. Essentially, the client saying, I'm not needing it. This is a much larger amount, required minimum distribution amount that's needed for any of my lifestyle spending. Many clients, have pensions, have Social Security, even cash on the sidelines, whereby they're not needing those monies. And the big first one, the taxable kind of brokerage account, essentially an account that's very good to receive assets, especially later on in life as there's compounding in that account. When received by an heir, getting a stepped up basis, so they're receiving it essentially tax-free. You're able to invest in this account slightly different. It's definitely a different tax nature from an IRA. You can buy, sell, buy, sell, buy, sell, and there's no tax ramifications until the money comes out of the account. Whereby with the brokerage account, it's much different. You're really kind of nickeled and dimed along the way, but still it has some of its own merits and benefits. For example, one that I always use with clients, let's say hypothetically, you bought $100 worth of Apple stock, and in, let's say, a year and a half from now, you go to sell it. It's worth $200. Well, that $100 of gain is considered taxable income. You held it for over a year, so it gets a little bit more favorable of a tax rate than likely where you're at with your required minimum distributions, your income out of an IRA. But in addition to that, if you sold it, you owe some taxes. If you didn't, you don't. But you also have to pay taxes on any dividends. If you were to buy a bond fund, a loan to company fund, essentially, any interest payments, also taxable. So again, kind of getting nickeled and dimed along the way with that account. But it's a very good account to have increased liquidity and for possibly future years where maybe an emergency happens, you have a larger expense, you want to get a new deck, you want to buy a boat, you want to get a new car, and that brokerage account really allows for a lot of additional tax planning down the road where we can still try to keep you at a low marginal tax rate, but then go into the brokerage account, kind of determine what to buy and sell to make sure we can get those monies, that liquidity to you at a very cheap tax rate. So that's the big first one. Definitely a good account to continue to invest in. Another one, qualified charitable distributions. If you're talking with your advisor and things are looking really great, you're spending noticeably less than what's, I guess a tipping point for your account whereby, we see your account growing for many years into the future. These qualified charitable distributions that we had talked about make a really good opportunity for giving to charities. Now, there are some considerations with qualified charitable distributions. You generally can't do it yourself. You normally have to kind of contact our team, and we're able to kind of send your payments directly from your IRA to them. It can't hit your bank account. You can't be, for example, at church and kind of put money in the basket. You got to go about it a slightly different way, but you can generally distribute up to $100,000 directly from a traditional IRA to qualified charities each year, and that can definitely go against a required minimum distribution to kind of keep your taxable income lower. So, instead of giving with dollars out of your bank account, after tax dollars, we can do it with pre-tax dollars directly from your IRA. And then a third big one, definitely as required minimum distributions are turned on, a lot of folks will have had children and therefore possibly grandchildren. And with those grandchildren often come, especially nowadays with the exorbitant prices of education, possibly taking those monies and putting them towards a 529 college education savings plan. You save a little bit of state taxes if you're in a state where there are state taxes, Michigan, for example, 4.25%. And by putting those monies in there, you can definitely kind of gear the conversation with grandchildren to kind of, if you want them to go to college or a vocational or trade school, have some money set aside, whereby it'll be paying for that on kind of a pre-tax basis and an account that can grow without taxes for any education. Those are the big three, Jim, that I often see. On very rare occasions, there is one more account that I often see is for possibly for any children or grandchildren that are still working. If they're not fully funding their retirement and you've more than fully funded your retirement, kind of contributing towards possibly IRAs or Roth IRAs for the next generation, assuming that they have some earned income. So the brokerage account, qualified charitable distributions, 529 education plans, and occasionally IRAs and Roth IRAs are kind of the big four that I've usually seen with clients on taking any of those RMDs that aren't necessary and getting them to work somewhere else for yourself or future heirs of your money.
That's terrific. Yeah, thanks. Those would be exactly the big three or four that I would say we use often. Again, folks, remember the vast majority of clients are factoring in their required minimum distribution as retirement cash flow. This is part of what they're planning on using to support lifestyle. But in quite a few instances, we have clients who have less of a need for this, and there's some really cool things that can be done. Let me just touch on a couple of those that you mentioned. The QCD, qualified charitable distribution, hugely impactful. A couple things about that, as you can actually start that at 70 and a half, regardless of when you're taking required minimum distribution. So if you're taking it at 73, you can actually use some of this account for charitable intent even before you're required to take money out. And the other thing that trips some people up is everybody thinks that regarding QCD, you can only distribute to the extent of your RMD. That's not true. You can actually distribute up to 100,000, I think, from a charity. So if in the case of that $1 million example where somebody has to take a 3.7% distribution, which is 37,000, if they had more charitable intent than that, or as an example, they had a big income year from a distribution or whatever, taxable, they may want to take a much larger distribution out that particular year from the IRA. That'll save a whole lot of tax dollars down the road, and they can certainly exceed the amount of their RMD. With legacy and planning for the next generation, 529 certainly makes good sense. We would highly recommend that. As you mentioned, as we mentioned on a prior episode, the other cool thing is some of that residual money in those 529s that aren't necessarily used for education can be converted to a Roth IRA, giving that next generation a bucket of money that can then grow for many decades, also tax-free. Hugely impactful. Another thing that can be done with RMDs as it relates to legacy. For some individuals, there's a lot of moving parts here, and it's not the right answer for everybody. But as an example, you could, and this is going to sound a little wonky, you could establish an irrevocable trust. You could fund it with life insurance. You could use the distributions from the RMD to make those premium payments. And depending on if everything worked out according to plan, there would be some leverage or increase potentially in the amount of what that gift would be over and above the distributions themselves. For the right client, depending on the right amount of assets, if there was a whole lot of illiquid assets that are being inherited, to be able to use this to fund something that would create liquidity, to provide additional tax payment opportunity, certainly makes some degree of sense. So there's a lot of really interesting things that can be done with regard to that. Beyond that, save it, reinvest it, use it, enjoy it. You spent a lifetime accumulating this money, and when you get into your 70s, it's time to smell the roses. One last thing I'll share, and it really has more to do with the next generation as well. The rule of thumb generally is the older you are, the less volatility you want, because you simply don't have the time to ride this thing down and ride it back up. And that's truly the case. But if the intent is, hey, this is money that we're probably never really going to ever spend ourselves, having the ability to move it out of the IRA, either through conversion or otherwise, and get it into, let's say, a Roth, but then manage that Roth not like we're managing it for a 70 or 80-year-old individual, but we're managing it like we're managing it for their 40-some-year-old children. That account can grow significantly greater over your remaining years, providing an even bigger inheritance on a tax-preferred basis as well. So I think, I don't want to speak for you, Dylan, but bottom line, it's important to engage with a professional and sort these things out well in advance. Because depending on your interest, your goals, your aspirations, there's some incredibly powerful things that can be created that would achieve those goals in spades. So with that, let me turn it over to you, Dylan. Final words before we wrap up today's episode.
Yeah, to that point, it's very impactful in regards to your situation, having a conversation with an advisor to make sure that what your goals are, where your resources are, that your situation is being affected as best as possible. With that, it's very important that the clients, with these different buckets, kind of what Jim had mentioned, with the Roth IRAs being managed more aggressively, with possibly other accounts being a bit more conservative, just having kind of an overall plan for every single dollar that you have, because at the end of the day, our job as fiduciaries for clients is to make sure that you and your family hold on to your money as best as possible and not give it to the federal and state government. So that's really where an advisor comes in and makes sure that you are winning the game, you are winning the tax planning, you are winning the investing, and making sure that your self and your heirs are going to be best off. And one more kind of parting thought, something more likely for a future podcast, required minimum beneficiary distributions. So for most folks, you've saved over the years in a 401k or 403b or have monies in an IRA, and that's kind of treated based on you, whereby an inherited IRA, also known as a beneficiary IRA, it has slightly different required minimum distribution kind of timeline. Essentially, with the required minimum distribution for your own monies, those can be essentially spread across your entire lifetime, but there's a much more finite, usually 10-year period. Again, there's a lot of more nuance to that, but usually about a 10-year period whereby you'll have to be taking those monies out, kind of calling in the need for even more tax planning to make sure that you're meeting any minimums that are required. You're taking it based out on your goals and as well as your future kind of marginal tax rate. So again, conversation for another day. So thank you so much, Jim. I really enjoyed being a part of this podcast and having this terrific required minimum distribution conversation with you and all the different considerations that our clients need to think about to make sure that their plan is kind of in order while talking with their advisor.
Thanks so much, Dylan.
All right, gentlemen, before we go, and that was a fantastic discussion, how can people reach you if they've got questions?
Well, they can reach us on our website, kaydanwealth.com. They can call us on our 800 number, 800-638-6900. There will be contact information in the header notes at the bottom of this podcast as well. There are plenty of opportunities to get a hold of us.
Fantastic, and thanks. So as we wrap up our discussion of RMDs, we hope the tips and stories shared here today will be useful for your retirement planning. Preparing for RMDs, as you've heard, is key to optimizing your savings and managing taxes effectively. And Dylan, thank you. Your insights have been incredibly valuable, and we're already looking forward to having you back to explore even more aspects of retirement planning. Thank you so much for being with us today. And listeners, please be sure to subscribe to the Retirement Engineer podcast so you don't miss future episodes. And follow at Kaydan Wealth on social. Let us know what you think in the comments. And of course, please share topics you'd like us to discuss in future episodes. Following and sharing this podcast helps our small show make a larger impact.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.